Hello students. So my name is Gaurav Bansal. I teach Indian economy, and if you're watching this video, most probably you already know about me. So let us start our question on taxation. Now there are certain concepts which have been in news and otherwise important for PT. So tax related concepts important for PT, and these are direct tax versus indirect tax. So what is there regarding the direct versus indirect tax? So we just need to know the basic properties that direct taxes, what are their properties. So direct tax are collected directly from people who bear the burden of tax. Remember this term, burden of tax. This is very important in this context. Burden of tax. So who bears the burden of tax? If you go to a restaurant and eat food, you pay GST on your bill. The bill is paid by the restaurant owner later on. You do not pay the bill to government, tax to the government, but you pay that tax to the restaurant owner. Restaurant owner will later pay to the government. So even though tax is paid by the restaurant owner, the burden is on someone else. So where the person is able to shift the burden on someone else, the person who is paying the tax, if that person is able to shift the burden, then it is an indirect tax. Okay? And if the person is unable to shift the burden, it is a direct tax. Unable to shift burden. Okay, ultimately there is someone who pay the tax, and usually in most of the circumstances it is the customer. In rare circumstances sellers may bear the burden of tax, but generally it is customer. So indirect taxes, for example, GST, sales tax. Okay, sales tax in India is called VAT, and similarly we also have the central excise, the excise, and another important indirect tax is the custom duty. So these are some of the indirect taxes. And then income tax, corporation tax, these are direct taxes. So this is what you need to know. Who is bearing the burden of tax? If that same person is paying tax, it is a direct tax. Okay? So you are now clear? Able to shift the burden of tax? Indirect. Have to bear the burden of tax? Direct. Okay, so this is regarding the technical classification. Then what is the other classification? The impact of tax on economy, not on individual but on economy. So direct taxes, I'm writing only for direct. Indirect you can understand it is other way around. Now direct taxes are generally progressive. Progressive in nature. Because we are collecting directly from people who are bearing the burden, we can tax them higher according to their ability to pay, and that is what government do. People who have higher income, they pay higher taxes at a higher rate. Not only because their income is higher, they also pay at a higher rate. So that is a progressive tax. So direct taxes are generally progressive. The same is very difficult in indirect taxes. So indirect taxes are generally regressive or neutral in nature. Why do we call them regressive? Okay, for example, let us say a restaurant has a 5% tax on food. Now, whether Mukesh Ambani eats there, Hrithik Roshan eats there, Arvind Panagriya eats there, you eat there, I eat there, or any poor person, random street person eat there, everybody has to pay 5% tax on the food. So remember, 5% tax is same on everyone. So people are not paying according to their ability to pay. People are paying same tax, and everybody is paying the same tax. So according to that logic, it should be neutral. But then we call it regressive because rich people spend less of their money. Poor people spend more of their money. So indirect taxes, since they are generally on consumption, on spending, poor people end up paying more taxes in comparison to their income. I'll give you an example. Let us say a rich person has 10 lakh rupees of monthly income, upper middle class, let us say, okay, monthly income. Similarly, there is a poor person with 10,000 rupees of monthly income. Now, between these two people, there is a gap of 100 times. This poor person with 10,000 rupees monthly income is unable to save anything, is spending roughly 9,500 to 9,600 every month, almost zero savings. Okay, so since that person is spending a majority of the money on the consumption, and let us say on consumption there is 10% GST, you buy anything, let us say average GST is 10%, then this person end up paying roughly 950 rupees as GST on the consumption. Roughly 9%, 10% tax of their income as GST. A rich person with 10 lakh rupees monthly income is spending only 2.5 lakh rupees. This person spend 2.5 lakh rupees per month, save 7.5 lakh rupees. Because this person is spending only 2.5 lakh rupees, what is going to happen here? On this person also, indirect tax will be 10%. So this person will pay on 2.5 lakh rupees, 25,000 rupees. But on a 10 lakh income, that is a very small tax, a 2.5% tax on the person's income. So in short, a rich person pays relatively much lesser proportion of income as indirect tax. That is why we call them regressive, not neutral. Neutral or regressive, they can be regressive. That's what we are trying to argue. Okay? Later on I will discuss how we can make indirect taxes progressive also, okay, in the GST topic later on. Now, I hope this direct versus indirect taxes are clear here. Now, examples of direct and indirect tax. Okay, which of the tax is direct, which of the tax is indirect. So, think about it. A very tough option here is stamp duty. STT, Security Transaction Tax. Stamp duty, security transaction tax are actually tough to answer. But I've checked it clearly with the detailed budget documents of Government of India. Both of these are considered direct taxes. Stamp duty, because the person who is submitting the tax is also the one who is bearing the burden of the tax. You buy any house, you pay property tax as stamp duty. You buy a car, you pay road tax as stamp duty. You are buying car, you are paying tax. You can't ask anybody else to pay tax on your behalf. Okay, so that is why stamp duty is borne by the person directly. Okay, so there can be some examples. Some people might argue that showroom owner takes money from you and they submit the tax, that's why it is indirect. No, it's not like that. Showroom owner is providing a service to you. It is your duty to submit the stamp duty and you can directly do it. You should directly do it. If they are doing it for you, they are charging from you over and above the tax. They are charging you convenience fee also for that. So they are just doing a service for you, but it is your duty. You are bearing the burden. You are supposed to file the tax. You hire someone for that purpose, it's okay. You can hire CA for filing your indirect taxes. Sorry, direct taxes, my bad. So stamp duty is a direct tax. STT is a direct tax, security transaction tax, which people pay on the purchase, sale of stocks. So these are the two tough examples. Okay, and then you need to know about other. Most important direct taxes are stamp duties for states or local bodies, and for union government it is the corporation tax and the income tax. These are the most important direct taxes. Rest there is a long list. Okay, I can share the list also of the direct and indirect taxes. So in the video description or maybe in the comment itself, I will follow the download link for the documents, support documents, where you can find the MCQs and where you can also find the support documents like the list of direct and indirect taxes. So you can check that out. Now coming back to this direct versus indirect tax, I hope is clear. Value added tax. Simply I just want to add one thing to value added tax. I can't discuss the entire concept here. The value added tax is simply a tax system where it is used for indirect taxes, by the way, and it is a tax system where the entire tax collection works on the basis of input tax credit. Input tax credit is the fundamental feature of the VAT. Okay, so how does VAT work? You sell something to someone, you collect tax from them. The person to whom you have sold, if they are going to sell those products later on, that means they are themselves shopkeeper, then they do not have to pay the tax technically. They will be able to claim the tax back. Let me make it easy and simplify. I am a shopkeeper, I sell something to someone. On every sale there will be GST. I have to collect GST from buyer. I have to pay it to government. Now, the person to whom I am selling, जिसको मैंने सामान बेचा, अगर वो पर्सन खुद भी आगे सामान बेचने वाला है तो हम मानकर चलेंगे कि ये इंटरमीडियरी ट्रांजैक्शन है. We will consider it to be an intermediary transaction, and that way we are going to treat it a way that the person will be able to claim refund on this. That is called input tax credit. For that person it is not a final product. For that person it is an input. It is an input. So if you buy something as an input to be used for your production, to be sold later on, then you get refund. If you are buying it for your own consumption, then you have to pay taxes. You can't get refund. Taxes are collected every time. A shopkeeper buying for business purposes will always get refund. This is the fundamental basic concept of the value added tax, and also GST, which is nothing but a value added tax, integrated value added tax. So what is the difference between GST and VAT? No difference. GST is just an application of VAT. See, VAT is a concept. Unfortunately in India we have used VAT for the tax name as well. Okay, it's like using Colgate for toothpaste. In many places of India, people go to a shop and say, "Bhaiya wo Pepsodent wala Colgate dena." So that doesn't make sense. If you say that, "Give me that Pepsodent wala Colgate," for them Colgate is a synonym for toothpaste. So like that in India, VAT is a synonym for sales tax, because we called our sales tax VAT after 2006. So now we consider VAT to be a specific tax, but no, VAT is a concept on which we have implemented GST. When we introduced VAT in India, basically we used VAT for sales tax, and sales tax was not the first time we used VAT. We used VAT earlier for excise duty as well. Okay, we called it SENVAT. So likewise, there have been various applications of VAT, right from excise duty to sales tax and now services. So now we have a goods and services. Goods, it was already there. On services we have extended it. So that is the GST. GST Council. GST Council, I just wanted to talk about one small thing, very small thing, that the states have 2/3 of the shares or the voting rights, and the center has 1/3 of the voting rights, and decisions are taken on the basis of majority vote. So that is how the GST Council works. Okay, and all the decisions regarding changes in the tax rate are taken in the GST Council. So there is an argument that states have lost their freedom to change tax rates. So yes, that is true. But if we want one tax rate across India, then obviously states have to lose some freedom there. Either you can have one nation, one tax, or you can have in freedom for all the states. It is better to have one nation, one tax, I believe. We have already given some freedom to the states regarding their petroleum taxes, etc. Okay, so cess and surcharge. I will discuss it with a question. No need to discuss it separately. Okay, surcharge is a temporary increase in tax. Okay, it is an additional tax, whereas cess is a tax on tax. Okay, cess is a tax collected for a very specific purpose. Surcharge is not like that. So these are the two major differences. Another major difference, cess you collect for certain purpose and you will use it for that special purpose, whereas same is not there for surcharge. Then tax buoyancy. It is a concept related to tax. What is tax buoyancy or buoyancy? The tax buoyancy simply means the tax rate which is floating over and above the GDP rate. What is the concept of buoyancy? It comes from physics. In the physics we study buoyant objects. Buoyant objects are those pardon me if my pronunciation for buoyant is wrong, because I've heard various pronunciation. My school teacher used that, so that stuck with me. So buoyant objects are those which are floating on liquid surfaces such as water. Those are called buoyant objects. Typically we take water as the benchmark. So tax buoyancy is an application from physics to economics actually. See, most of economics is developed by people with background in physics. Most of it is developed by scientists, physicists particularly, or mathematicians. Hardly anyone with commerce or economics background, okay, from Shri Ram College of Commerce. Not to make fun of Shri Ram College, it's a great college, has produced great many scholars, but my point is, the subject of economics is not an area where such people have contributed to. It is an area where mathematicians have contributed. People with physics background in fact have contributed most. So a lot of terms, in fact the next term also is coming from physics itself. So tax buoyancy come from physics. So object which float above water surface. Here tax which always remains above GDP. What does it mean? That your tax revenue grow more than the GDP growth rate. Then we call it buoyant. Otherwise we call it non-buoyant. That is the concept of tax buoyancy. Okay, tax buoyancy is a very important feature, because if your taxes are not buoyant, then GDP will grow faster, taxes will grow slower. Over time, the tax to GDP ratio will fall, because one is growing slower than the numerator here is growing slower. So tax buoyancy here would be very, very clear to be a very beneficial thing for government, that they always get higher tax to GDP. It will improve with time, and government will always have a lot of funds. So tax buoyancy is a very important feature. If it is not there, then tax revenue will fall over time in proportion to GDP, which is a bad thing. Tax elasticity, next concept. Elasticity we have understood in the microeconomics. If you have not seen lecture on microeconomics, please go back to that. On my channel you can find that very easily. That was session 1 in the revision classes. So that is the class on microeconomics where we discuss elasticity. Elasticity is the same, stretchable objects, flexible solids or objects which can be stretched. Okay, so tax elasticity, where there is some stretching ability, where there is some flexibility. So what is tax elasticity? Tax elasticity is proportional change in tax with proportion to, or with respect to proportional change in economic growth or GDP. Okay, so generally GDP is the one we take. Just written, if tax elasticity alone is written, you do not know what is there as a base. So tax elasticity of GDP or GDP elasticity of tax, that is how it should be written. But generally when we say tax elasticity, we generally refer to GDP. So percentage change in tax divided by percentage change in GDP, that is tax elasticity. So generally if tax elasticity is high, flexibility of government is high, it is good. Then windfall tax, I will discuss it with a question. It is there in the question as a concept. Okay, some of them I will discuss with the question. Then MAT, DDT, corporate tax, STT, CTT. Okay, MAT, DDT, corporation tax, these are the group of taxes. Okay, these are all part of the corporation tax group in a way. So MAT is a minimum alternate tax which people have to pay if their corporation tax payment is less than 15% of their gross profit. This is the rule. Corporate tax is on net profit, but there is an additional condition that even in ratio of gross profit it should be 15%. If you find this too technical, I will cover it as a separate topic. This entire family of tax I will cover separately, but for now this is the short discussion here. Okay, DDT, dividend distribution tax. Okay, so those who receive dividend, they have to pay DDT. Okay, and then STT, CTT is there, security transaction tax, which is on stock trading, buying and selling stocks, shares. CTT, commodity transaction tax. Just like stocks, people also buy commodity. Okay, gold future, iron future, etc. So that is CTT, on sale and purchase of commodity instruments. So these are all the direct taxes. Okay, these are all example of important direct taxes. In addition to these, we have income tax and we also have the stamp duty. Unless there is a very specific type of stamp duty in which there is a condition which makes it indirect, it is direct. Unless anything specific is given, you consider it direct. Retrospective taxation. Retrospective taxation means tax which is imposed from a back date. Means I impose a tax today. I say that from now I am introducing a tax, but people have to pay this tax even on their old incomes. That is unreasonable. Let us say we increase the tax rate tomorrow to 35%, but we say this is applicable from a back date. From 2020 onwards, anybody who earned more than this income has to submit this much tax. This is wrong. So retrospective taxation is actually against the principles of natural justice. So you should not have retrospective changes in the tax. In India, it became a controversial topic because to tackle with the Vodafone case, government did it, and it became a very big reason for problems for government of India. Okay. Then there is a concept of global minimum corporate tax. So OECD, Organization for Economic Cooperation and Development, the club of rich countries, that has agreed that there should be a global minimum corporate tax. Means every country should have a minimum tax on the company's profit. Okay, companies make profit, they have to pay taxes just like people pay it on their income. But many countries like Seychelles, like Bahamas, like Panama, these small island countries generally, they offer very, very low taxes, unreasonably low taxes, sometimes even zero taxes. Even Dubai had zero tax, by the way, okay, corporation tax. There was no corporation tax. You can make profit, you do not have to pay tax. That was the system in Dubai because government was getting a lot of income already from oil. There was no need for a tax. But as a result of this, a lot of other countries lose their business. A lot of American companies go to Bahamas and set up their headquarters there. A lot of Indian companies have set up their headquarters in Singapore, for example. Now, as OECD has said that countries like Panama, Nicaragua, okay, Seychelles, Panama, they also have to have a minimum of 15% of global minimum tax. Means they also need to have a 15% corporation tax so that a company has no advantage shifting abroad and countries should not lose on their tax revenue. So that is the concept of global minimum corporation tax. Now you know what is the impact? Immediately it was announced, Dubai or UAE in fact switched to a 10% corporation tax and they are saying they will make it 15% in steps. Then there is inverted duty structure. Inverted duty structure simply means that tax which is against the natural or general system. What is the general system? We charge less tax from input and high tax from output. Okay, that is there in general system. But in inverted system, what happens? We charge high tax from input but less tax from finished goods. We are talking about import duty. Okay, so think about it. If there is someone in India who is making mobile phone and they are importing microprocessor from outside, RAM from outside, they have to pay 15% tax on that. But somebody is importing Chinese phones or Japanese phones and selling them directly in India. Okay, somebody is just importing finished product, they have to pay 5% tax. This is against reason, this is against logic. We should have high tax on finished products so that people in India are encouraged to manufacture. If not manufacture, at least to assemble. But inverted duty structure is against the domestic manufacturing. So in the last decade, we have over time addressed this problem. Okay, inversion is eliminated to a large extent. So this is all regarding to the concepts. I've given you a good revision or a decent revision, at least I believe so. If you believe so, please provide it in the comments or like the video, share the video. Okay, but I think I've covered a lot of concepts here. Now let's look at the questions. So question number 1. With reference to India's decision to levy an equalization duty of 6% on online advertisement services. Okay, this is a previous year question from 2018. Offered by non-resident entities. Which of the following statement is or are correct? First, it is introduced as a part of Income Tax Act. No, it is not introduced as a part of Income Tax Act. Okay, it was introduced separately, okay, as a financial bill. So it was not introduced as a part of income tax. Then second, non-resident entities that offer advertising services in India can claim a tax credit in their home country under the double taxation avoidance agreement. So the answer is it doesn't provide any incentive in double tax avoidance agreement. Okay, we need to understand it is not a corporation tax. It is on corporation tax. It is on other taxes that there is adjustment in DTAA. There is relaxation, refunds or credit under DTAA. But it is not so for equalization tax. So in this case, neither one or two. So that would be the answer. Second question, which is also a previous year question. A decrease in tax to GDP ratio of a country indicates which of the following. So which is the concept related to the tax to GDP ratio? The tax buoyancy and elasticity. Okay, these are the concepts. Let's see how they apply. Basically, a decrease in tax to GDP ratio. One, it will decrease when there is lack of buoyancy, when the tax system is non-buoyant. So what are the problem when your tax system is non-buoyant? Slow indicates, okay, which are the following are reason for a non-buoyant tax system. Slowing economic growth rate. This is one of the key reason. When economic growth rate slow down, then corporate profits dip even more. Okay, when economic growth is decent, companies' profits grow faster. When economic growth is slower, companies also have a bigger decline. Okay, so there is a threshold in the growth rate. If growth rate is, let us say, above 4%, then companies are likely to surpass that level in their profits. But if GDP growth rate is less than 4% for a country like India, then basically companies are also not going to have good profits, and that results into a low tax to GDP ratio. So slowing economic growth rate is a big reason for decrease in the tax to GDP ratio. Okay, less equitable distribution of national income. Now this can be correct and this may not be correct. Okay, but the question is not saying may indicate. Indicates means it should happen. Do not look at the option, I'm just reading the question right now. A decrease in tax to GDP ratio of a country indicate which of the following, means which should be happening. Should be happening. Okay, it is not a situation we are saying that which of the following are possible when this is happening. So less equitable distribution of national income, it may or may not be there as a reason. It is still possible to have buoyant tax system despite a less equitable distribution. So this is not a condition that necessarily affects the tax buoyancy. So in this case we cannot select this, okay, because the question doesn't say may. It is an affirmative statement, so only one will be chosen. A will be the answer. It was a tough question because it's not so easy to reject two, but you need to look at the question very carefully. Question is affirmative or question is optional. Next question. Okay, this is from this year's budget. Consider the following statement from India's tax collection for financial year 23. Indirect tax collection have once again overtaken direct tax collection. Is it true? No. Okay. It was looking as if indirect taxes will take over the direct taxes, but this didn't happen. The GST collection was rising rapidly. Because GST collection was rising rapidly, we thought maybe this year indirect taxes will once again surpass the direct taxes. So somewhere around 2004 in India, direct taxes surpassed indirect taxes. Let me explain what I'm saying. The government collect taxes and there we follow a binary, means either of the two. The taxes are either direct or indirect. There is no third possibility. If it is not direct, that means it is indirect. So direct, indirect plus if we add it up, it is the total tax collection, means 100. Now out of this, the indirect tax collection for the central government used to be, okay, the indirect tax collection for the government used to be higher than the direct tax, but that was until 2003-4. Okay, somewhere around 2004, the direct taxes started to be more than the indirect taxes. Then indirect tax collection went down 50% and direct tax went above the 50%. Since then it is following the same. At one point of time, direct taxes were offering almost 57-58% and indirect tax were offering or giving only 42 or 41% of the tax collection. So that much was the difference at one point of time. Now they are almost 50-50, but they have not yet surpassed. Okay, so it is a trend which survey also highlighted, that indirect taxes are likely to take over direct taxes in future, but not yet. So they have not yet. Indirect taxes are generally considered progressive in comparison to direct taxes. I have discussed it as a concept before starting the question, so I think I do not have to discuss it again. Answer should be D, neither one nor two. Okay, both are wrong. Question number 4, with reference to inverted duty structure. Now I discussed inverted duty structure also. Let us look at the question. Under this, tax rate on input is higher than the tax rate on final product. So this is correct. Under the inverted duty structure, this is true, and that is why inverted duty system is bad. Okay. And second, under GST regime, the inverted duty refund is also applicable on input services. So this is incorrect. This is actually as per Supreme Court orders. Supreme Court gave an order and reversed this. Okay, now it is not applicable on input services, only on input goods. So that is what we have. So in this case, only one is correct. Fifth, in context of taxation in India, consider the following statement regarding the cess. I told you cess and surcharge we will discuss with the questions. Proceeds from cess is initially credited to Consolidated Fund of India. This is correct. Cess, surcharge, they both go to Consolidated Fund. In fact, all the budgetary income go to Consolidated Fund. You should not have a doubt here. All the income that is received in the budget goes to Consolidated Fund. What goes to the public account of India? The borrowing that government of India does from people, or from people, remember, okay, not from banks, financial institution. That doesn't come in the public account of India. Directly from people. What government of India directly borrow from public? Through Provident Fund schemes, through other schemes like Sukanya Samriddhi Yojana, through post office bank accounts. That goes to public account of India. And what goes to Contingency Fund of India? Donations from public to Prime Minister Relief Fund, President Relief Fund, all of that goes to Contingency Fund of India. So there are many relief funds which contribute to Contingency Fund. In addition to that, we also provide fund from other sources. So proceed from cess go to consolidated. Should not have a doubt here. The central government may not share the revenue collected from cess with the state. That is also true. The surcharge and cess are not shared with the states. Okay? And that is why states have a problem against it. And we say cess and surcharge, although there is a logic behind them, they should be there, but they should not be too much. Because the income from that is not shared with the states. Today, almost 20% of the income of central government, tax income or tax revenue, come from cess and surcharge. This is not fair. It should not be more than 7-8% or 10% at max. Sorry. Third, if cess is collected in a particular year, cess collected in a particular year goes unspent, means the central government is unable to spend. Let us say it collected Krishi Kalyan cess or Swachh Bharat cess, and it collected 13,000 crore rupees under that cess. Then the government must spend that money on Swachh Bharat mission, but in a year, let us say it is able to spend only 9,000 crore. What can happen with the 4,000 crore? Is it possible that government can use it for some other purposes? The answer is no, it cannot be done. It will be carried forward to next year. You have to spend it next year then, but you can't use it for other purposes. So third is wrong. Okay, so 1 and 2 only. C will be the answer for 5. 6. Which of the following best describes the tax expenditure? Best describes the tax expenditure. Okay. So, what is tax expenditure? The expenditure incurred by the government on collection of tax. Is it true? No. Tax expenditure is basically the expenditure due to lack of collection. Suppose you have to give me 30 rupees and I have to give you 5 rupees. Okay. I collect entire 30 from you and then later I give you 5 rupees. Is it also not a better way that I directly collect 25 from you, I deduct 5 already? So if I collect the money in the first way, it would be like government collecting the complete taxes and then giving subsidies. Okay. Government collect taxes, give subsidy. Tax expenditure is basically when government decides, okay, we are not giving you subsidy, rather you do not have to pay us tax for that much amount. Okay, we reduce your tax burden. Rather than collecting the tax and then giving subsidy, we want to reduce the tax burden itself, so that the money you would have received later as subsidy, you save that money directly by not paying that much of tax. So that is tax expenditure. The proportion of income that household pay as tax, no. Revenue foregone on account of incentive and exemption that are given to taxpayer. This is exactly the definition. Revenue foregone, revenue given up, revenue lost, okay, lack of collection. That is tax expenditure. Advance expenditure from a possible tax. So C is how we define the tax expenditure. A, how do we define A? The expenses incurred on the collection of tax. We call it tax collection cost. Clear? Tax collection cost. The D here is not at all related, so let's leave that. Question number 7. Consider the following statement with reference to the equalization levy. So what is equalization levy? Equalization levy is basically a tax on the foreign companies. Companies which are registered in India, but they are not present in India. They are only registered. They are offering services in India through their foreign offices directly, through cloud computing or through whatever manner. They are not directly present in India, non-resident companies. So now such companies, because they were not present in India, they were not paying many of the taxes and we were losing such taxes. So now we have said, okay, now you have to pay equalization levy, means you have to pay same tax as other companies which are present in India. So equalizing tax, levy means an imposition of some tax or fine or fees. That is levy. So levy, equalization levy, बराबरी करने के लिए हम आप पे अतिरिक्त भार डाल रहे हैं. Okay, so we are imposing additional burden on you to equate you with others, to create equality between you and others. So that is the funda. It is an indirect tax first introduced in 1996. Is it correct? No. It is first introduced in 2016. Okay, so first is wrong. It applies to the resident Indian entities, not at all. For non-resident Indian entities. Okay. Non-resident entities, in fact, Indian is also not. Third, it is imposed on the online sale of goods and services by e-commerce companies. Yes, it is imposed on that. The answer is no, we are saying only. It is only saying that it is imposed on this. Yes, it is imposed on this, and that's why it is correct. If it would have been saying only, then it would be wrong. Okay, only is not there, so now we can choose it. Because it is not saying this is the only way it is collected, these are the only type of company. It is only saying that it is there on this. So third is correct. You have to become good in reading the options very clearly. Same option with just addition of one word can become wrong. Affirmative statements and non-affirmative statement, that you should be able to discriminate out. So answer should be D, 3 only. Clear? Now, 8th. Recently seen in news, GAFA tax is related to which of the following? Okay, you can read more about GAFA tax. Basically, it is a tax very much like the Google Facebook tax or equalization levy that was introduced in France. So initially, a lot of countries opposed when India imposed the equalization levy. In journalistic circles, in newspapers, this was more popularly referred to as Facebook tax or Google tax. Technically, it is called equalization levy. Now, the Western countries opposed this idea, but later on even France and many other countries have found it to be useful thing, and even France today has this imposed on the non-resident companies. Okay, it is a tax on the largest tax firm providing services to the French customers. Okay, so if you are doing business in France, but you are not present in France or any country basically, you still have to pay the taxes there because you are generating your business there. Economic activity is in that country, so you are liable to pay taxes there. Just because your company is in USA doesn't mean you are immune from the taxes in other countries. So initially people were opposing India, but now they've understood that this is a big problem because from one country alone, a company can rule the entire world and all the countries will lose their taxes. So, next. So in this case, D is the answer. Okay, you can see it later on. Please download these MCQs. Okay, not all of them are prepared by me. Some of them I have prepared, some I found on internet. If there was a good question, I've picked it up here. So it's not that I've made all the question exclusively here, but yes, I have made many of them. Some of them are UPSC past year question, and a few, when I found a decent topic covered somewhere, I've included a few of those. Okay, about 1/4 of the question maybe. Question number 9. Okay, but you should download the slides. I'm providing link every time and you should check out again. It is a tax imposed on the basis of monetary value of the tax item. Okay, the most common example of such taxes are property taxes levied on real estate. Most suitable option for the tax mentioned here is, it is a tax imposed on the monetary value of the tax item. Okay. The answer is ad valorem tax. Okay, ad valorem tax. The second statement is only to confuse you. The most common example, yes, property, in fact all the taxes today are ad valorem tax. Ad valorem tax are the tax which are imposed as a percentage of the financial value of transaction. You buy something for 100 rupees, tax will be 5% of that, 2% of that. Okay, you earn 5 lakh rupees, tax will be 30% of that. So taxes are percentage of the value of the transaction or income. So taxes are imposed on the basis of monetary value of the tax item. So that is correct. Stamp duty is also an ad valorem tax. So second statement is correct, but it is only confusing you. All the taxes in modern economy is ad valorem. What would be an example which is other than ad valorem? And tax which would be non-ad valorem tax would be per unit tax. For example, government say that 1 rupee on every product we will charge for a certain welfare cess. 1 rupee, irrespective of the price of the product. If product is 13 rupees, then also it is 1 rupee. If product price is 130 rupees, then also it is 1 rupee. You are not saying on the 5% of that, 1% of that, you are not saying that. You are saying 1 rupee on each product. If you define it in terms of money, each unit, then it is per unit tax. That is an example of non-ad valorem tax. But all the taxes, most of the taxes in modern economy, there will be only a rare exception are ad valorem tax. Okay, so this is the standard tax system today. 10th, with reference to the digital service tax, which of the following statement is or are correct? So first, it is restricted to online advertisement services only. Only is the problem, because digital service tax is on any type of service activity, okay, not just online advertisement services. So you are providing consultancy, on that also there can be digital service tax. Second, in India, it specifically exclude domestic digital business from its ambit. Okay, so that is correct. It specifically exclude domestic digital businesses. It is only on non-domestic digital businesses. And third, tax not on income but on revenue. That is also correct. Companies' revenue that they earn, on that they have to pay tax, not on their profits, retained profits, net profit, not on that. It is on their revenue. Okay. So this is regarding the digital service tax, very much like equalization levy. Okay. Next question. A tax is said to be buoyant if the tax revenue increase less than proportionately in response to a rise in the national income or output. So buoyancy we have already discussed. A tax is said to be buoyant if the tax revenue increase less than the proportional in response to rise in national income or output. So tax revenue is rising less than the change in income. So this is wrong. Then it is non-buoyant. Second, the Laffer curve describes the relationship between tax rate and tax revenue. This is correct. So what is Laffer curve? Laffer curve looks like this. On the y-axis, we have tax revenue. On the x-axis, we have tax rate. The argument of Laffer curve is, as tax rate increase, the tax revenue also increase, which is logical. If government increase the tax rate, it should be able to get more income. But the Laffer curve say there is a limit at which tax revenue maximizes. After which, if you increase tax further, the tax revenue will go down. Means, if tax rates are too high, then a lot of people do not pay their taxes. It encourages people to become dishonest. More and more people, let us say if tax rate is above 60%, 70%, let us say this threshold is at 70% tax. Then what will happen? At 70% tax, a lot of people will think, okay, I will not pay taxes. Tax is unreasonably high. Even if I'm caught, they can take all. Anyways, they are taking so much. Okay, so they have more incentive. If they are not caught, they save everything. But if they are caught, then they have to pay everything. Between these two options, they think it is better to stick with not paying the taxes. So this happens when tax rates are unreasonably high. For example, in India, tax rates were very, very high during the 1970s and 80s. Sometimes exceeding even 80-90% in the higher slabs. So when tax rates are so high, what will happen? People will become dishonest. So in the 70s and 80s, a lot of people became dishonest. This system, corruption, okay, tax evasion became institutionalized in India because we made system unreasonable for an honest person. If you make conditions unlivable for an honest person, even a lot of honest people will turn dishonest. Honesty is not just a personal virtue, it is also about the conditions. In the countries where the laws are so strict that you are directly beheaded for stealing, there the problem of theft would be lower. Okay, so it is also about condition. Then in a country where there is a lot of prosperity, people do not have to steal. People in general take care of each other. There also conditions matter. Society take care of its disadvantaged people. Okay, Japan for example, people donate them generously. Restaurant feed you with dignity and respect if you are homeless. Then also people do not steal. Okay, so it's about the condition also. But if conditions are not like that, okay, then people become dishonest also. So in this case 2 is correct, 1 is incorrect. 12th, withholding tax. Withholding tax is also known as retention tax. What is withholding tax? I am giving you a very short and sweet and simple answer. It is the TDS. When you are making payment to someone, you should collect TDS and deposit it to government. For example, a company has taken a building on rent. Every month it pays 5 lakh rupees rent to the building owner. Then it is mandated by government that it will cut 10% from that tax payment, rent payment, and it will submit that to government as tax. You are withholding money. A company has hired consultancy. It make payment to them. Those are not employees, they are consultant working for a company. When company make payment to them and the payment exceed 2 lakh rupees or 1.5 lakh rupees, let us say, then it becomes a rule for this company to mandatorily to deduct 10% of that payment and pay it to government in their behalf. It will be deposited in their name. So you are withholding the payment. So TDS is simply an amount which is withheld by government for loss making pay, as you know. In fact, we can directly opt for D. TDS I have given here as a easy hint. Okay, an amount of which deduction takes place directly from earning of an employee by the employer. So that is TDS. Out of all the option, it is the most suitable amount which an employee withhold. Employee doesn't withhold. The one who has to make payment, that person will withhold. Amount withheld by government, union government. For state government, no. Answer is D. Next, GAAR. It comes into effect general anti-avoidance rules. Okay, so there was a set of rule. Anti-avoidance means that is against tax avoidance. It comes into effect when an agreement is entered with the main purpose of obtaining a tax benefit. So that is correct. When you enter into an agreement transaction for the purpose of tax benefit, that is called tax avoidance. Tax avoidance is not illegal. Tax avoidance is fully legal, where you are taking advantage of loopholes of the law. So government very carefully checks all the transactions where it doubts people are doing it only for saving taxes. And if they find something wrong with those type of transactions, they impose penalty. But by default, they are very much legal. Okay, company is very much well within its right to do so. Problem is when those companies provide false information also or provide incomplete information also. Tax avoidance means action taken by a taxpayer, none of which are illegal or forbidden by law. That is also correct. If it is illegal or forbidden by law, then it is tax evasion. Tax evasion is a problem. Tax avoidance is more of an administrative problem. Government has to change the law and remove loopholes. So in this case, both are correct. Okay, so C will be the answer for 13th. 14th, with reference to cess and surcharge, consider the following. Cess is a tax on tax that is imposed by central government for specific purpose. That is correct. Cess is a tax on tax. Then surcharge is an additional charge or tax. Is that correct? Yes. Surcharge is an additional tax. It is not a tax on tax, but an additional tax. Surcharge goes to Consolidated Fund of India, but can be spent only for the specific purposes. So yes, first half is correct. Surcharge go to Consolidated Fund of India, but it can be spent for any purpose. It should be cess here for this statement to be correct. It is cess which must be spent for specific purpose. So third is incorrect. 1 or 2 are correct. E should be the answer for 14th. Okay, and with that we have completed this discussion on the tax concepts, and in the next video I will discuss the questions related to economic survey. Okay, and I hope you have liked this video. This video has been useful to you. If you find it useful, kindly spread the word, and it's just a small channel, so your contribution will help a lot. Just like it, share it, okay, comment it. It will improve its validity on YouTube. Thank you.